Ladies and gentlemen, welcome. It's my pleasure to welcome you all back to our Lunch and Learn with the Wine series. I've got my little trusty little glass of red here, which I probably shouldn't be having before 12, but luckily it's after 12 o'clock now. It's usually after 12 somewhere in the world, isn't it? So we sort of get away with it. We're here thanks to your financial advisors, Virtual Financial Advice. My name's Paul Jantz. I'll be your host for today. And look, let me just, for those of you that are joining us for the first time, let me just quickly recap on a few things that we've been doing probably over the last 2 or 3 years now, which has been fantastic. These Lunch and Learn with the Wine virtual workshops were created just to provide an extra layer of education to all of you, the clients, and to invite you into probably a little bit of our world, but also just to share a little bit about probably the investment opportunities in the marketplace. And that's what Adem's been able to do quite successfully with a number of the alliances that work alongside him at Virtual Financial Advice. One of the other things we did over the last couple of years as well was we introduced a podcast series, which was very, very popular. We called it Talking Numbers Investment Plus, where Adem and I went through probably a 6 or 7 part series, took everyone through. It's a great little podcast series. So if you wanted to search for it in Spotify, it's called Talking Numbers Investment Plus. And then we also did one called Talking Numbers Property Plus. And that was with a property agent, property expert by the name of Jay Anderson. And Jay's also an expert in all sorts of things, but he is a property advisor. So he's got the license to talk about property as an investment, which is brilliant. So yeah, look, if you want to look at that as well, Talking Numbers Investment Plus and Talking Numbers Property Plus. Today, we're here to take you through a quarterly update, and I'm going to quickly hand over to Adem Becirevic, who, as the CEO, will sort of give you a bit of a say hello. 2, will also introduce you to our special guests from Shartru Wealth, Rob Coyte and Clint. I'm not quite sure if Clint's on yet, but we'll wait for Clint.
He's having technical issues, apparently.
Yeah, that's what happens with this. Happened to me last week with Zoom. It starts to go through a reboot or whatever it is, but that's all good. Clint will be with us soon. So, Adem, I might hand over to you first of all, and you can introduce Rob and the relationship you have with Shartru, more importantly.
Thanks, Paul. Yeah, look, it's exciting times. It's the first time we've actually held this MDA update for our clients. Really exciting. All the clients I'm talking to want to know more about the MDA. They love that we're using a managed discretionary account. They love that we're a boutique firm. We're not just a big firm, maybe like a Q Super that's just putting all their clients' funds into certain areas. We explain to our clients we've got a risk-adjusted portfolio. They're really loving that and very interested in hearing about it going forward. So the whole idea for us is to really do this every quarter. So every quarter we'll do an update. We'll have Rob, who's the CEO of Shartru Wealth, with us, and Clint, who's be joining us very soon, to give updates to our clients in regards to how the portfolio is going, how the returns are going, what changes we're making, and just to give clients a bit of an update in regards to our portfolio. So today we've got Rob Coyte, the CEO from Shartru, who does a fantastic job running the dealer group and the investment committee. And then we've got Clint, who's head of the investment committee, who's going to be joining us very shortly as well, to give us an update on kind of what's going on.
Magnificent. Thanks, mate. And look, we will be taking questions. So if you've got any questions, you've got the bottom there, you've got the Q&A bar. So please type any questions that you'd like there, and we'll allow probably 5 minutes at the end for questions. We'll be online for about 35 to 40 minutes. Let me take you through some of the things we are going to talk about. So we're going to give you a bit of a market update, what's happened probably for the last quarter. We'll give you a bit of the performance of the Gerrora MDA Growth Fund, which is important. We'll talk about changes to the fund during the quarter, the future of the MDA, why use an MDA with and I think you just spoke about it, with a risk-adjusted approach, which is important, and how you can use an MDA in a self-managed super fund. So, gents, let's get into today. I think last time we spoke, Rob, funnily enough, I think we spoke about this, and I think interest rates were around 2.6%. I had a look at the last time we looked at this, I had a bit of a laugh, thinking, wow, hasn't things changed a little bit? So let's kick off.
Things have changed a lot, Paul.
It's funny, but just ridiculous, actually. But let's kick off with a bit of a market update. Tell us what's happened for the last quarter.
Yeah, okay. Well, in regards to the last quarter, it was pretty much, it was an interesting quarter. It was pretty much what we sort of referred to as a bit of a risk on quarter, which basically means investors have got their appetite back. What we saw was the S&P 500, which is the US-based index. It got an increase of around about 8 or 9% for the quarter. Interestingly, that wasn't a broad-based rally. So basically, when you see markets go up, you want to see all stocks in the market go up. It was very, very concentrated in a group of stocks called the Magnificent Seven, which is the artificial intelligence sort of, the wham bam, the new trend sort of stocks. It was really that was driving the market and lifting the market up. And that's a bit of a concern, and it's a bit of a bearish signal from us, from our perspective. In Australian dollar terms, it was around about 6 or 7% for the quarter, which is not to be sneezed at. The Australian market, it did about 1% for the quarter. So obviously it wasn't as robust as the offshore lead. But interestingly, to me, the big question at the moment is interest rates, and it has been the big question for the last couple of years. We're pleased to say that we've got pretty much that call right. So what we saw last quarter was the Australian Treasury yield, which is basically what people are willing to lend money to the Australian government for 10 years. It rose from 3.24% to basically 4%. Now, that's a big difference, okay? What that also means is that when you enter an instrument called a bond to do that, as interest rates increase, the value of that bond decreases, okay? Because the coupon payment, the amount of interest you receive from the government every year is fixed. So when interest rates go up, the only thing that can move is the value of the bond, and the value of the bond has been going down. Which basically resulted in the Australian bond index going down around about the 3% mark, which, bonds are our defensive part of the portfolio, so that's not something where we want to be. And that's exactly what we've been doing from a strategic perspective, is we refer to it as short or low duration, which basically means we're not taking a long-term exposure regarding the amount of money that we're willing to lend to governments or corporates. We're only doing it on a short-term basis. So when we get these big movements in interest rates, it's not going to impact upon us. So we're pleased to say that's a trend that we've had right over the last couple of years, and we've had massive outperformance because of it. And it gets back to, I guess, Adam's point on about, not the big boys tend to have to buy everything. We don't have to buy everything, and that's exactly what we're doing. We want to buy what we want to own, and we want to avoid what we want to avoid. And that, to me, is probably a perfect example of this at this point in time.
Yeah, well said, well said. It's an interesting one. I remember going to a lunch in Sydney, and they were talking about bonds at the time, and they're up at around 6%. Is that about right? Maybe
that would have been corporate bonds.
Okay.
So depending on the level of risk, depends on government bonds are the proxy. They're referred to as risk-free. They're not really risk-free, and we might talk a little bit about that later in the world of inflation, right? Yes. But in theory, someone like the US government will not default, right? Because basically they'll just print money, right? So they won't nominally default. You'll always get your nominal dollars. The real question is, what are they worth in inflation adjusted terms, or what we refer to as real terms? And that's the real interesting thing about investing at the moment, which we haven't had to face for the last 20 years, is how do we preserve our real value of our wealth, allowing for inflation? The central banks are telling us it's gone back down again and everything's fine. We all know, we all pay bills. We know that everything that we're spending money on is a lot higher than what they are telling us it is.
Absolutely. Absolutely. And then I saw only last week they're talking about our fresh produce also starting to increase again, where sort of they were coming down and everything else is going up. So our cost of living is continuing to increase. Yeah.
And I'm always a bit wary of the official inflation figure. It's the old saying, a good scorer beats a good player. Basically, they adjust that figure all the time. They play with it. The US actually adjusted their figure earlier on this year. And in the middle of an inflation crisis, when you sort of change the rules, it's sort of that should be a red flag. But from that perspective, it gets back to the other thing that they do is they've got this basket of goods that they refer to, which is constantly changing. But then they might say, oh, well, let's strip out things like food, energy, housing, basically everything that we actually spend our money on.
Yeah.
And then they say, well, that's actually reflective of spending habits. And you sort of look at it and think, well, I don't know if it is. So we're very wary of those sorts of numbers. And there's, we're probably more interested in looking at other things in the market that is telling us what the market thinks inflation is doing.
Yeah, fair call. Just a quick welcome to Clint. G'day, Clint. How are you?
You're on mute, Clint.
Oh, he's still having technical problems.
You're on mute, Clint.
Yep, sorry, I did have some technical issues.
All good, mate. Just thought we'd say a quick g'day because we'd sort of introduced you before, but we were waiting for you to come on. So it's good to have you on, mate.
Sounds like Rob's all over it.
Yeah, and you got anything to add, please jump in at any stage and just add anything you'd like to add. Let's talk about the performance of the Gerrora. Is that how I say it? The Gerrora?
The Gerrora, yep.
Okay, good. I sort of got that right, I think. The MDA Growth Fund. Adem, is that probably something you'd like to start with initially, and then you can bring Rob or Clint into the conversation?
Yeah. So basically, Gerrora is one of the funds that we use for our clients. It's one of the portfolios that we use, and however, with a lot of our clients, we have we design personally their portfolios for them. In regards to some clients might already be heavy in property, so we might leave property out of the portfolio, and we might weight more towards shares and fixed interest and so forth. So Gerrora is just one of the portfolios we use, but that's kind of like our flagship that we kind of use for our clients. And so the returns have been great over the last few years. Clients have been very impressed, and so it's done its job.
Let's talk about the performance.
Yeah. Okay. So just on that, the performance, the way we structure these products is it's really around risk adjusted returns, right? So what we mean by that is, traditionally most people have equities and bonds, and so if there's equity markets going well, everyone's making money, it's all good, right? What the view that we take is that, well, there's going to be periods where equity markets work really well, but then there's going to be periods where equity markets don't well. And being a student of financial history, that happens a lot, and it can happen for a very long period of time. We haven't seen that for a while, but that doesn't mean that it's not going to happen. So what we're focused on is we're focusing on basically having access to a range of assets that are going to behave differently at the same time. Because what that does is it gives the clients a much smoother ride, and it enables them to stay on their journey for the long term, which is exactly the strategy that Adem's putting in place for them. So on that, so the performance for the last quarter was quite good. So we got 3.61% for the quarter, which against our benchmark of 1.5%. So outperformed our benchmark, which was great. Also, against our peers, we outperformed. Our peer average was about 2% for the quarter. So once again, that was a good performance number. In the short term, obviously, it's great to get good numbers, but what we're really focusing on is long term, making sure that we're chipping away, doing what we need to do, getting good returns, absolutely, but also making sure we protect on the downside. And that's basically the sort of what we're trying to do for clients.
Brilliant.
And I think Paul, it's also interesting to know that with our clients, when we're ever doing projections or retirement planning, we always base everything around a 6% mark. So we're not basing it around 8 or 9 or 10 or 12 or 15. So always very conservative in regards to what we're doing for our clients. So we're not trying to get 25% returns, but just if we can get that 6 to 8%, we're happy as a pig in mud.
Yeah, good. Yeah, excellent.
Well said. Let's talk about the future of the MDA. Why would someone continue to use an MDA? Is it just because what you guys just mentioned just then?
Yeah, in essence, I think Well, there's a couple of things. I think our underlying philosophy in the MDA is, exactly what we spoke of, and it is very much a different approach in the market. I think the market per se has an approach of let's just get great returns, let's get the highest possible returns that we can, and granted that works 80% of the time. It's the other 20% that we're worried about, and it all falls apart, and that's when clients need to be protected, right? What we don't want to be saying to clients in those periods is we don't want to be saying, oh, well, don't worry about it. It's a 20-year strategy. We've just taken a big hit, but in a few years it'll all be good, right? Markets do that sort of stuff, and that's exactly what you've got to do. But in saying that, we need to make sure that we're taking the appropriate amount of risk. And at the moment, it is our belief that there's a lot of people taking a lot of risk out there, and they're not taking into account the, well, this could happen moment.
Yes.
Everyone's got very complacent. Clint, you're on mute, but would you have anything to add to that?
No, I don't think so, Rob. I think you've pretty much covered it. And I mean, people have been taking on a lot of risk over the last couple of years. More risk than necessary.
Do you think the and I think, Rob, you sort of mentioned it before, the AI, the artificial intelligence hype, let's call it. And I don't know if that's the right word that I should use, but I'll use it because there's a lot of chatter about it, I suppose. So that creates a lot more hype in the marketplace. And, even as recent as, I think it was last night, actually, the new Shark Tank launched last night, and there's an AI expert that's made a lot of money in the AI space. That then heightens people's ideas, perceptions, thoughts. Let's have a look at this and let's see if this works. Is that fair to say?
Look, I view it like this, like artificial intelligence. It sounds exciting. It sounds scary. What's it going to mean for us? I wouldn't have a bloody clue, right?
Yeah.
But what I do know, and I draw the parallel to what happened in the internet boom, right? When the internet boom happened and we had the internet and everyone was looking at this internet thing and they were sort of, oh, wow, this is amazing. We all knew it was going to change our lives, right? But we really didn't know how. And how people reacted to this internet boom, that anything that was a company that was to do with the internet just went through the roof. Right? And that didn't have any longevity about it. And one day everyone woke up and sort of thought, well, just because the internet's there doesn't mean this thing's going to make money, and everyone had a reality check. So you've always got to be careful of these sorts of things. But in saying that, absolutely, it will change how we live and how we do things and what have you. But it gets back to no one really knows what that looks like. So what we need to do is we need to manage the risk, right? Yes. We have got some exposure to it, absolutely. But we haven't got so much exposure to it that if we get it wrong, we're going to go, oh my God, what the hell happened there?
Yes.
That's exactly the scenario that we want to avoid.
Yeah, I suppose, talking about AI, you look at ChatGPT as a good example. And again, I'm not quite sure who owns them, and I think they're private at the moment. But the amount of the way that's allowed us to change the way we work, and probably I know I use it quite a bit to write certain things, and obviously the time aspect is what you get back. But right now, you're right, we don't know what that will mean in the future. But it's a scary place, isn't it, when you think about it, of what it can do. Now they're talking about, I saw something to do with it recording voices, and it's just got, it's like it's got its own shelf life that who knows what the hell it can do.
Yeah, but I mean, at the end of the day, it's, whether it's algorithms or what have you, it'll have a view. It doesn't mean that view is going to be right.
True.
You can probably go and ask 3 AI systems and they'll tell you different things, right? So to me, regardless of what happens, the devil's always in the detail, right? You use it to write stuff, right? Well, in your message, there's really only a couple of things that are really, really important, right? And that's the thing that is you, and you're making sure you get the message across that you want to get. So, I think it is exciting, it is interesting, and all that sort of stuff. The death of humankind, I'm not a believer in that. I just think it's going to be another tool, the same as the spreadsheet was, the same as the computer was, the same as the internet was, that'll make us more productive, and we'll be spending more time doing the things that are value add or
Yes.
making decisions,
Yeah.
as opposed to spending time doing the grind work, if you will.
Yeah, correct. And that's probably a good example to not get sucked into the, call it the investment side.
Yeah, and what happens with investments is when there's euphoria, people having stupid expectations. So one of the ones I always remember from the internet boom, which I mentioned earlier, was I think it was Intel. And basically it got to such an absurd valuation that if they sold all the computers in the world and then increased that supply by 50%, it still wouldn't have justified the valuation it was at. So you sort of think, well,
yeah,
it gets back to, you can have a good asset but pay too much for it, and that's what euphoria does. It sort of forgets about that second part of the equation and just runs with the first. But eventually there will be a wake up call.
Yeah, it's exactly right.
Is there going to be any opportunities though, Rob, you think in the future? Like obviously when Microsoft and Apple and all those companies came along, and obviously when fund managers bought them back when they first came out, obviously now they've obviously done pretty well. Is there going to be any like Apples or Microsofts coming along with this new AI investment?
I think inevitably, yeah. The question becomes who are going to be the winners, and again we'll go back to the internet boom. To be perfectly honest, no one really knew. I think people sort of thought eBay was going to be pretty special. But they thought a lot of things were going to be special too that didn't turn out to be. So that's the trick, right? It's knowing which one will be the one that becomes the next Apple. If you look at Apple itself, it's had a couple of times where it's nearly fallen off the perch completely. But now it's what's it valued at $3 trillion or something? It's something ridiculous.
Ridiculous.
You just don't know.
Well, just when you think that it's like, what more could you do? They seem to come up with more, and obviously their valuation just continues to soar.
But even if you look at their valuation, right? So their valuation is really dependent upon iPhones and iPads, and basically making sure that we all go out and upgrade with the newest model. But you think about it, it doesn't take too much for that to stop. It might be higher interest rates and people have just got to hang on to their money a bit longer, and you might sort of, I might just keep the phone for 2 years instead of, getting the latest one. And all of a sudden, if enough people do that, that will hurt their top line and their bottom line. And then the market goes, well, hang on, this isn't as easy as we thought.
Yeah, very true. Very true.
So it's just things like that, they eventually give the reality check. What it's going to be, we don't know. But from our perspective, we tend to be what we call a value house, which is what we're trying to find things that we're paying a good price, as well as trying to find things that are going to get better over time. We just think that provides an extra margin of safety for investors when they because invariably markets will move against you. But it's good to look at something and go, well, something was cheap, now it's really, really cheap. As opposed to saying something was really expensive and we were hoping it was just going to keep going, and then, well, it's still expensive. That's not a good mindset to be in. So that's the sort of investing we avoid.
Yeah, well done. I think that safety element is so important to everybody right now, isn't it? Because again, I know a lot of people could have taken certain risks and higher risks in other areas, and at the end of the day, it's all about consolidation and making sure, I think Adam mentioned it before, in terms of that retirement planning, you want to make sure that you're on track for where you want to head. And if you can, I know, Adam, you've spoken about a number of different stories over the last times we've done these where people didn't think they were in a position to retire earlier, but they could have. And that's the great part about what you guys do at Virtual Financial Advice.
Yeah, exactly.
Yeah, exactly. It's, at the end of the day, Adam, what Adam's doing with clients is making sure they've got enough money to do what they need to do. Feed the dog, go on a holiday, whatever it is. And to make sure that continues, and to make sure it keeps up with inflation. That's exactly what Adam's trying to do with his clients.
Yeah, well said. What about an MDA and a self-managed super fund?
Yeah, that's preferred structure. Clint, you might want to talk about that one.
MDA and a self-managed super fund.
Yep.
Yep. As an advisor as well, it's my preferred structure. There's various reasons that we actually looked at that. And one of the primary reasons there is it allows us to act very quickly. If circumstances change on the market, such as COVID or date back to the GFC, it allows us to actually jump in and make a single change to all clients' positions if there's a particular investment that gets into trouble. Or on the flip side, if an AI opportunity presented itself and we needed to put 100 different clients into that position, rather than have to ring and discuss that with 100 different clients, the MDA allows us to take that position straight away and take advantage of that before it slips through our fingers.
Yeah, I think that's the great advantage of the MDA, isn't it? Just to be able to act on that quickly, as opposed to, like you said,
Correct.
make calls and possibly miss out.
Yep, 100%.
Brilliant. Adam, anything else you want to add to that, mate?
Yeah, I think also with MDA and super, like I think the cost benefits once clients get above a certain level can really be great savings. Like, people think that Q Super and Australian Retirement Trust and all this are cheap funds, but when you get over that, probably $500,000-$600,000 mark, it's, a self-managed super fund can be very beneficial, cost-wise, as well as having a great strategy in place. And we want to personalize all of our portfolios for our clients, and you're not going to get that from an industry fund.
Yeah, I might just add, Adam, yeah, I agree entirely with that. And the thing I like about the self-managed super fund structure is the individuals are the trustees. It's not some cardigan wearer in George Street or Collins Street, or Eagle Street or whoever, telling them what to do. And that gets back to our philosophy of, we want to be able to do what we want to be able to do. We want to avoid what we want to avoid. We don't just want to do everything just because some trustee says, oh, you've got to do this, you've got to do that. That's not the environment we want to be in. And that's why I love self-managed super funds and using an MDA. And
the MDA also provides us full transparency of what we own. So that if you had a question about it, we can easily answer that.
Yeah, it's well said. Yeah.
Fantastic. Did you say cardigan wearer?
Cardigan wearer, yeah.
I thought you did.
Mind you, they probably wouldn't wear cardigans up in Brisbane, would they?
Maybe down here at the moment, it's only like 10 degrees in Melbourne, so maybe down here, but I haven't put mine on today, so it's not something that's in my wardrobe. So guys, in terms of, and if anyone's got questions, please throw them into the Q&A, because we'll take questions very soon as we look to wrap up in the next 5 minutes or so. But the next 12 months, what does it look like?
Well, it's just business as usual. I think as far as things that we'll be looking out for, we're still going to be watching this interest rate story. We're still going to be watching this inflation story. We've actually got exposure to a number of things that are going to hedge us against inflation. We've got an exposure to precious metals, and I also think that we're probably going to be looking at the potential for equity market weakness going forward. The market's still very strong when you consider when we opened up that interest rates have gone from next to nothing to where they are now, and there hasn't been too much fallout. And this has been the biggest and the quickest interest rate rise in history. So I expect some fallout from that. Clint, I don't know, what are your thoughts about going forward?
Yeah, I think it really depends on inflation, real or imagined, whatever they want to put out, and future interest rate rises and the effect of how that's going to flow through to the economy, especially in small business, because obviously a lot of small businesses are struggling because especially people with mortgages have significantly less money to go around at the moment. So it's just something we're very cautious of, and that could, as Rob said, play out into the equity markets and potentially property markets as well.
And the banks are tightening up too.
Very much so. Yep.
Yeah. So that's never good for small, medium-sized business either. So there's a few things that we're sort of watching and keeping an eye on.
Yeah, well done. Adam,
what's Rob, and what's your thoughts on the currency rates at the moment? Obviously, the Australian dollar's been smashed over recent times, and down to as low as 62 or something like that, which is in my time, God, it's incredible. I remember going to America. I think it was about 9 years ago, and it was parity. Dollar for dollar was quite good. Whereas go to America now, my son lives over there. Go and see him; it'll cost me a fortune.
Yeah. Well, I actually spent time in a foreign exchange desk for one of the big banks.
Yep.
And the thing I learned there was whatever you think foreign exchange is going to do, you'll probably be wrong. So it's a tough one, but what we are seeing with foreign exchange, generally what you see, one of the short term is the differential in interest rates, right? So if you think about it, investors have, when they hold cash, right, they're thinking about what return they can get. And so with the US has massively increased their interest rates. So what people are doing is they're saying, well, I can go and put money in the US dollar assets and I can get 5% risk-free lending it to the US government. That's pretty attractive on a short-term basis. Okay, so that's the sort of thing that's been driving that. Long-term, what will actually happen, and it's already happening. If anyone caught what was happened in the BRICS meeting this month, and I actually haven't caught up with what was going on there, but these guys are actually having the other conversation, which is where they're saying, well, on a long-term basis, we've got things that are valuable. We've got fuel, oil, gas, real things. When we sell it, you're giving us these US dollars, but we're holding these US dollars, and notwithstanding we can get 5%, we actually think it's losing its purchasing power because of inflation a lot quicker than that. So they're sort of saying, well, hang on, I don't think I want to own these things anymore, right? So that's the dynamic that will be playing out over a long term. And I honestly think that the US dollar, it is in a change, and these changes take decades. It's not something that's going to happen next week. But the appeal of the US dollar is less than what it was. And Clint and I were actually having a yarn yesterday about who's actually holding treasuries at the moment. And the big boys, China, Japan, a lot of these guys, they're selling treasuries net. So it's an interesting dynamic.
Okay.
Fantastic. Look, and I suppose that's what's great about these, that we're looking to do these every quarter, where I suppose, you learn a lot more about what is actually going on in the marketplace and looking at what's happening, and then obviously having you guys as the experts sharing that knowledge that we as clients don't have. So it's great to have you guys sharing all of that. So thank you very much. I'm going to go to some questions before we look to wrap up. There aren't any questions at the moment. So while we're waiting for some questions, Adem, why don't you share some exciting news that you've got coming out later this year? If I prompt that, will it trigger something for you?
Later this year, in regards to my travels?
No, your book.
Oh, okay, a book. Okay, yeah. Well, hopefully later this year. I'm just been in the process of writing a book. So once that's finished, definitely all my clients will be receiving a copy. Yeah, it's a book in regards to financial advice and trying to help people that need advice, not just our clients, but other people that might need advice that can't afford it, and just trying to spell out the different ways and obviously talk about it, the MDA, and talk about how we invest and how we do things and the processes we go through and what an advisor looks at. The 6 key areas of their financial life, and we talk about those 6 key areas. Then we talk about looking at that every year. I talk about in the book about what our clients should do, and we explain to our clients that every year they should take a day off every year and look at their financial life, and just give them a few tips around that, where I've found my clients have found it very beneficial, and they've given me that feedback, saying, oh God, it's the best thing we've ever done, because if you don't go to the bank and ask them to reduce your interest rate, they're not going to knock on your door and do it. So it's all about you, like as our slogan, it starts with you. If you don't do anything, nothing's going to happen. So in the book, it's just about showing, clients and people that aren't clients, what they can do to try and, increase their wealth and retire comfortably. And, one of the things we do is, part of our fee paying clients is we do a retirement plan for them every year. And I think that's really important. Yeah.
Absolutely. And I think that's the beauty of you guys are online being clients. And so what Adam just mentioned before, that retirement plan, when you talk to other people, and we go to barbecues or dinners or whatever it may be for a glass of wine right now. When we go there, and if you ask whoever that you're with, do you have a retirement plan? Very few people have a retirement plan, which is the fantastic what you guys do.
And even lots of them that have advisors still don't have one. So you know, that's kind of one of the key things. That's part of our point of difference is we make sure all of our clients have that, they're on track. Yeah. And you know, we want to show clients that, you know, they don't necessarily have to. I mean, obviously we want them to see an advisor, but if they can't afford to, or they think they can't afford to, we'll show them the steps and where they can go to be able to do that themselves.
Brilliant. Here you go. We've got our first question. Thanks, Robin. What are the top 3 sectors the MDA is invested in percentage terms? Where is property in this commercial, residential?
Yep. So every strategy is obviously different, but inside the growth portfolio, I think we've got around about 20%, Clint, in property.
Correct. Yep. That's a mixture of unlisted property, and there's a little bit of listed property exposure in there as well.
So you might just sort of talk about the 2 differences there, Clint, just in basic terms.
Yep. So your listed property is obviously by its nature listed on the stock market. So it's your A-REITs and things like that. So companies that people may have heard of there is like your old Westfield type shopping centres or GPT shopping centres, amongst other things. And then it's got some unlisted property, which is investments that are not listed on the stock market. So they might be various office towers or industrial complexes, things like that, that are not traded every day on the market. And that sort of exposure is what does provide us with some uncorrelated returns to the market. So what we're after there is that point of difference where some of the listed stuff, effectively, you can just view those as effectively shares, and the vagaries of the market. When people decide to sell off the market, a lot of that stuff will fall. Whereas your listed property, if you walk down, if your house is worth $700,000 today, just because the market's decided to have some little hissy fit and sell off, your property's still worth $700,000, and that uncorrelated returns in a lot of those industrial complexes and things like that. Yep, if it's worth $10 million today, it's going to be worth $10 million tomorrow.
Okay. And top 3 sectors?
And then, but then you've got Australian shares, you've got your international shares.
Correct. And you've got your industrial, Australian property, international property, and that international property may involve the US. We don't have a lot of US exposure. I don't know if people are aware of what's going on in some of that in regard to places like Seattle or New York and things like that. There was a office building sold in New York for basically the value of the ground, the dirt. So there was no value at all given to the property itself, the building. So we don't have a huge amount of exposure to the US, but it also includes Europe and places like that as well.
That wasn't Trump Tower, was it?
Sorry,
No.
that wasn't Trump Tower.
So a lot of the places in the US, the New Yorks, the Californias that Clinton was referring to, they've got vacancies up around 30%. So they're in a lot of strife. Interestingly, where Australia's looking okay, it's not too bad, notwithstanding the fact that, you know, the newspapers like to say it's terrible because everyone's working from home and they're never going back. But also places in Europe have been very resilient. And I guess a lot of that's got to do with the fact that there probably hasn't been a lot of construction there because they have had a lot of economic issues for the last decade or so. So their actual market's actually still like single digits in vacancies, which is quite normal for commercial property. So it's a bit of a mixed bag, to be honest. And if you're picking the right stuff, you know, you're looking pretty good still.
Yeah, and I just got off a meeting prior to this one with one of the fund managers that we do use, and they were saying the industrial vacancy rate in Australia is 0.6, which is the lowest in the world. So we do have some industrial exposure in there, obviously.
Fantastic.
Excellent. Yeah, so basically the top three sectors would be Australian shares, international shares, and what? And property?
Correct. So in
Property.
something like the Gerrora Growth, as Rob said, each portfolio is different.
Yeah.
So roughly in Australian shares, we've got about 25% in the Gerrora Growth. There's 20% in the property exposures and about 26% in international shares. That's in Gerrora Growth. Obviously, we then switch it out to something like the Gerrora Conservative. You're going to have that much higher weighting in your various fixed interest investments, where we're starting to see much higher returns come through in that, with that growth in interest rates. And I think myself and Rob were discussing the other day, people may have noticed there's some Millbrook specific option mortgage exposure within the portfolios. And you go back 18 months and we were getting maybe about 6% out of those, which is still higher than what we can get in a term deposit. But those new Millbrooks that are coming through, we're getting somewhere between 8.25 and 9% out of those, with a very low LVRs in the main.
Fantastic.
Yeah, fantastic. Well, gentlemen, thank you. What have we've just hit 12:43, so I think we'll look to wrap up. Thanks, Robin, for that question. Great question as well, and well answered, gentlemen. Adam, anything you'd like to say in parting comments before we look to wrap up, mate?
Yeah, I'd just like to thank Rob and Clint, and excellent work. And I love to do this every quarter to really kind of educate our clients and keep it rolling. So thank you very much, and thank you, Paul, for emceeing.
My pleasure. Yeah, I think we're looking at sort of the end of October, which will be our next one.
Yeah, the September quarter.
Sort of wrap up this particular quarter that we're in right now. So
yeah,
as ridiculous as it sounds, we hit September tomorrow.
Yeah.
Good parties, we're out of winter. Winter in Melbourne, that's important.
Yeah.
All right, fantastic. Well, Adam, thank you. Rob, thank you. Clint, thank you. Always great to have you guys on board and share your thoughts and wisdom and knowledge. I think it's fantastic for all the clients to actually hear that and work out where we're heading into the future, which is interesting, and what you guys are doing there are fantastic. So well done, Adam. Keep doing what you are doing. To all you guys that joined us, thank you very much. Until we see you next time, thanks again, and enjoy the rest of your day.